This question tests the calculation of the cost of preferred stock capital. Unlike debt financing, preferred stock dividends are not tax-deductible, so the corporate tax rate of 40% is irrelevant in determining the cost of preferred stock. Students should recognize this common exam trap. The company issues 1,000 shares of $100 par, 8% preferred stock. Since the dividend rate is based on par value, each preferred share pays an annual dividend of $8, 8% of $100. However, the company does not receive the full issue price of $92 per share because it must pay stock issue costs of $5 per share. Therefore, the company actually receives only $87 per share in net proceeds. The cost of preferred stock reflects the relationship between the fixed annual dividend and the net amount of cash received by the company. Because the company receives less than the share's stated value, but must still pay the full $8 dividend, its effective financing cost is higher than the stated 8% dividend rate. Choice analysis. A. 8%, incorrect. This uses only the stated dividend rate and ignores flotation issue costs. B. 8.25%, incorrect. This understates the cost because it does not fully account for the reduction in net proceeds. C. 8.7%, incorrect. Although closer, it still does not reflect the correct relationship between the annual dividend and the actual cash received. D. 9.2%, correct. The company pays $8 annually while receiving only $87 per share after issue costs. This results in an effective preferred stock cost of approximately 9.2%. Correct answer, D. 9.2%. Exam tip. For preferred stock, ignore corporate taxes because preferred dividends are not tax-deductible. Always base the financing cost on the net proceeds received after deducting flotation or issue costs, not on the par value or gross issue price. This question tests understanding of the cost of retained earnings, an important component of a company's cost of capital. Although retained earnings are generated internally rather than raised from external investors, they are not free financing. Retaining earnings means shareholders forego receiving those funds as dividends and investing them elsewhere. Therefore, retained earnings have an opportunity cost equal to the return shareholders expect on the company's common stock. The question specifically states ignoring flotation costs. Flotation costs arise when new common shares are issued and include underwriting and issuance expenses. Since retained earnings do not require issuing new shares, they incur no flotation costs. As a result, the cost of retained earnings is generally considered equal to the cost of common equity financed from existing retained profits. Students should remember that the cost of retained earnings reflects the return required by shareholders, not the accounting cost of keeping profits within the company. Choice analysis. A. The cost of common stock, correct. Ignoring flotation costs, retained earnings have the same opportunity cost as common equity because shareholders expect the same required return whether earnings are retained or distributed and reinvested. B. The same as the cost of preferred stock, incorrect. Preferred stock has a fixed dividend and different risk characteristics, so its cost is calculated differently from retained earnings. C. The weighted average cost of capital for the company, incorrect. WACC combines the costs of all financing sources and is not the cost of retained earnings alone. D. Zero or no cost, incorrect. Retained earnings are not free capital. They have an opportunity cost because shareholders sacrifice current dividends in exchange for future returns. Correct answer. A. The cost of common stock. Exam tip. Retained earnings represent internal equity financing, but they still have a cost equal to shareholders' required return. When flotation costs are ignored, the cost of retained earnings equals the cost of common stock common equity, making this a frequently tested concept in weighted average cost of capital WACC calculations. This question tests knowledge of the constant growth dividend model Gordon growth model, used to estimate the cost of retained earnings, cost of common equity. The model assumes that dividends will grow at a constant rate indefinitely and that shareholders require a return consisting of dividend yield plus expected growth. The key information provided is Most recent dividend equals $3 per share. Expected growth rate equals 9%. Current stock price equals $36 per share. An important point is that the most recent dividend is not the dividend expected next year. Since dividends are expected to grow by 9%, the next dividend will be slightly higher than $3. After adjusting for growth, the expected dividend yield is calculated using the expected dividend relative to the share price, and then the growth rate is added to obtain the required return on equity. The resulting estimate is approximately 18.08%, representing the cost of retained earnings. Because retained earnings belong to shareholders, the company must earn at least this return to justify retaining profits rather than distributing them as dividends. Choice analysis. A. 9.08%. Incorrect. This reflects only the dividend yield after adjustment and ignores the expected growth component. B. 17.33%. Incorrect. This results from using the current dividend without properly adjusting for next year's expected dividend. C. 18.08%. Correct. This correctly combines the expected dividend yield with the 9% growth rate, giving the estimated cost of retained earnings under the constant growth model. D. 19.88%. Incorrect. This overstates the required return and does not correspond to the correct application of the model. Correct answer. C. 18.08%. Exam tip. In constant growth equity valuation, always remember that the model uses the next expected dividend, not the dividend just paid. The cost of retained earnings equals the expected dividend yield plus the expected constant growth rate, making it a key component in weighted average cost of capital (WACC) analysis. This question tests the cost of retained earnings, which is a component of a company's weighted average cost of capital (WACC). The question provides information on common stock dividends, growth rate, debt, preferred stock, flotation costs, and taxes. However, students must identify which information is actually relevant. Since the problem asks for the cost of retained earnings, only the common stock dividend, stock price, and expected dividend growth rate are needed. The information about debt, preferred stock, tax rate, and flotation costs is a distraction. In addition, the question states that retained earnings are available, so new common stock does not need to be issued, meaning flotation costs should be ignored. The current dividend is $2 per share, and dividends are expected to grow at 10% annually. Therefore, the next expected dividend is $2.20 per share. Relative to the current stock price of $38, this produces a dividend yield of about 5.8%. Adding the expected growth rate of 10% gives an estimated cost of retained earnings of approximately 15.8%. Choice analysis. A. 9.5%. Incorrect. This ignores part of the expected shareholder return and significantly understates the cost of equity. B. 14.2%. Incorrect. This likely results from using the current dividend instead of the expected future dividend or another calculation error. C. 15.8%. Correct. Using the expected dividend of $2.20, the dividend yield is approximately 5.8%, and adding the 10% growth rate gives a cost of retained earnings of about 15.8%. D. 16%. Incorrect. Although close, it overstates the result and is not the best approximation. Correct answer. C. 15.8%. Exam tip. When calculating the cost of retained earnings, focus only on common stock price, expected dividend, and growth rate. Ignore flotation costs if retained earnings are available, because no new shares need to be issued.